looks like global growth is picking up a little in response to the easing of financial conditions we've seen in the past few months, but it's still stuck in this 3–3.5% range we've been in for the past few years. Not too bad, but certainly not exciting either. We're characterizing the situation as a stop-and-go world. That in the developed markets, that means the central banks are responsive to risk in both directions. In the US, as the risk has been fading on the downside, the Fed's again ready to raise rates, maybe in June, perhaps more likely in July. In the case of China, it means they're very sensitive to the risk of a hard landing. So they stimulate, they loosen credit in order to boost growth, and that's been quite effective in the past few months. But as growth picks up, then you start to focus more on deregulation, on deleveraging, and on reform, and growth slows down again. They're heading for an L-shaped recovery. So what does this mean overall? I think it means we have lengthy periods of calm, as we've seen in the past few months, followed by bursts of turbulence, such as we saw at the start of 2016. So you'd have no booms, but similarly, you have no real crisis either.
It seemed that the post-February takeoff in risk assets has reached cruise altitude. Just like on the flight path, it's not unusual for risk assets to face some market turbulence. The title of our June monthly investment guide is Turbulence Ahead, Buckle Up for You. As we look ahead, storm clouds are gathering in June as both the Fed and the BOJ are slated to make important policy decisions. China's policy-induced recovery is slowing down, and the UK will decide on whether to stay or leave the EU on the 23rd of June. Reflecting back, at the height of the market sell-off in February, we were convinced the discrepancy between an economically solid world and an overly bearish market presented a lucrative investment opportunity. Back in February, we tactically raised our equity allocation to an overweight position, and since then, equity markets have rallied significantly as the global recession proved to be a false alarm, and our overweight equity decision has reaped strong returns. While many investors have backed away from betting on recession and deflation, most investors are on the sideline observing the outcome from the risk events in June. With a general lack of conviction in markets, we think that markets will be trading in a wide range with heightened volatility. At this juncture, we think that market volatility will return, and given that markets are at the upper limit of this wide trading range, we are taking profit and bringing down our equity overweight call to a neutral. At the same time, we are bringing all our country allocation to neutral. We continue to stay overweight on emerging market high-yield bonds. Market turbulence is uncomfortable but not dangerous. It is part of investing and is not to be feared. In a wide-range trading market, the strategy for investors is to hunt for yield, look for value. Income is paramount in a high-volatility, low-rate world.